Imagine being in your 60s, sitting on a nest egg of 2.3 million in retirement accounts and staring at $200,000 in savings. You've done all the right things, worked hard, saved, invested. Now there's a big question. Should you use that $200,000 in savings to convert your retirement funds to a Roth IRA, or should you keep that cash close, just in case you need it later? This isn't just a math problem. It's about risk, taxes, and most importantly, peace of mind. Let's break down what's really at stake here. First, for anyone not up to speed, a Roth conversion means moving money from a traditional retirement account, like a traditional IRA or 401k, into a Roth IRA. The big catch? You pay taxes on the converted amount immediately, but then your money grows tax-free, and withdrawals in retirement aren't taxed either. That's a pretty attractive deal, especially if you think your tax rate will be higher in the future, or if you want to leave tax-free money to your heirs. Now, the couple in question has $2.3 million in retirement accounts, a hefty sum by any measure. But all of that is pre-tax money, which means every dollar they withdraw in retirement will be taxed as ordinary income. That can add up fast, especially with required minimum distributions, or RMDs, which kick in at age 73. RMDs force you to take out a certain amount each year, and those withdrawals could push you into a higher tax bracket, or even trigger higher Medicare premiums. So the idea is, if you convert chunks of that $2.3 million now, while you have some control over your tax situation, you could pay taxes at a potentially lower rate. Then, you'd never have to worry about RMDs on that converted money again, and you get tax-free growth on those funds. Sounds great, right? Not so fast. Here's the catch, and it's a big one. Taxes on a large Roth conversion can be steep. Let's say you want to convert, for example, $1 million over several years. Depending on your income and filing status, you could easily push yourself into the 32% or even 35% federal tax bracket. For every $100,000 you convert, you might owe $24,000 to $35,000 in taxes, possibly more when you factor in state taxes. That's why many people use after-tax savings, like this couple's $200,000, to pay the conversion taxes so they don't have to dip into their retirement accounts. But draining your savings to pay taxes is a tough pill to swallow. What if you need that cash for unexpected medical expenses, home repairs, or just the freedom to spend a little more in retirement? Once that cash is gone, it's hard to get it back, especially if you're not working anymore. And while Roth conversions offer long-term tax benefits, they don't provide the short-term liquidity that a healthy cash reserve does. Let's put some numbers to it. Fidelity recommends retirees keep at least 1 to 2 years' worth of living expenses in easily accessible savings. So, if this couple spends, say, $80,000 a year, that $200,000 covers about 2.5 years. That's a solid safety net. If they use it all to pay conversion taxes, they might end up with a bigger Roth IRA, but they'll lose the flexibility and peace of mind that comes with having cash on hand. Another important angle: life is unpredictable. Healthcare costs can skyrocket as we age. According to Fidelity, the average retired couple may need around $315,000 for healthcare expenses throughout retirement, and that's just an average. What about helping out family, replacing a car, or covering a roof repair? Once your liquid savings are gone, your only real option is to tap into retirement accounts, possibly at a bad time in the market or at a higher tax rate. Let's also consider the emotional side. Behavioral finance tells us that people value financial security, having cash in the bank, far more than abstract long-term tax savings. It's hard to sleep at night if you're worried about what might go wrong. So, what's the right move? There's no one-size-fits-all answer, but let's walk through some options. First, rather than draining all $200,000 of your savings for Roth conversions, you could convert smaller amounts over several years. For example, convert just enough each year to fill up a lower tax bracket, say the 22% or 24% bracket, without jumping to a much higher tax rate. This way, you spread out the tax hit and preserve some of your cash cushion. Second, it's smart to keep at least a year or two of living expenses in cash or short-term savings, no matter what. That gives you time to weather an emergency or a bad market year without having to sell investments at the wrong time. Third, don't forget about state taxes and other considerations. If you plan to move to a state with no income tax, it might be worth waiting until after you've relocated to do larger conversions. If you're already on Medicare, big Roth conversions can increase your premiums due to IRMA surcharges. And finally, remember, Roth conversions aren't an all-or-nothing deal. You can do them gradually, adjust each year based on your income, and even skip a year if something changes. It's not about maximizing every dollar of tax savings. It's about balancing future benefits with current comfort and security. The bottom line, don't sacrifice your peace of mind today for possible tax benefits tomorrow. If you're uncomfortable draining your savings, you don't have to. Consider working with a financial advisor or tax planner who can help you run the numbers and create a conversion strategy that fits your needs and risk tolerance. If you found this discussion helpful, please hit that like button, leave a comment with your own experiences or questions about Roth conversions, and don't forget to subscribe for more smart, practical financial advice. Remember, in retirement, it's not just about how much you have, it's about how confident you feel using it. How are you balancing tax strategies with your need for financial security? Let's keep the conversation going.